Hi everyone, this is Ashish with Investor Friendly CPA, and today we are talking about capital gain tax and how can you manage them. I want to cover two things in this video. First, why are capital gains so hard to manage, and how can you use something called qualified opportunity fund to mitigate this capital gain tax. I get so many questions on this topic. People ask me how can they lower their capital gain tax, and we have to understand that capital gain tax is not same as your normal ordinary income tax. You can manage your business income through business expenses and other deductions that you get to deduct for your businesses. You cannot do that with your capital gain tax. You don't have any expenses. All you can do is you can harvest some capital losses, which we don't want to do that. No one wants to lose money on stocks or any sale of your asset, right? Or you have to figure out a way to offset your capital gain tax with actual business income. So in a very high level, we can plan your investment in real estate and even businesses to harness the losses to offset your capital gain. But most people that I talk to don't have the business income coming in, or their real estate investment strategy is not done correctly to offset their capital gain. So what can you do to reduce your capital gain? We can use something called qualified opportunity fund. Okay, this is extremely complicated and is fairly new. So I'm just going to give you a high level overview, and you can look into with your own advisor and ask all the questions you have. So this incentive allows you to defer, not avoid, any capital gain that you made this year if you invest them in a qualified opportunity fund. So these are the tax benefits available under this incentive. The first is you can defer taxation on your capital gain until 2026. So I get asked all the time, oh, this is just a deferral. You cannot actually avoid taxes. That's true, but it gives you 5 years to actually plan your taxes so that you can offset your capital gain when you actually have to recognize it. We do this all the time. Your CPA or your tax advisor can plan your taxes in such a way that when you actually recognize this income in 2026, you can offset it with other losses that you're going to harvest. The second is this: if you invest the capital gain by end of this year 2021 and hold it for 5 years, you don't have to pay 10% of the taxes. The other one was 15%. If you had invested this your capital gain last year, or actually 2019, then you could have avoided 15% taxes when you actually had to recognize it in 2026. But that's already gone. We missed the deadline. The other benefit is this, and this is the biggest benefit I think from this incentive. You can invest your capital gain here, and this appreciates to, let's say, 10 million in next 10 years. You do not pay any taxes in that appreciation. So let's say you had a $500,000 gain from sale of your stock or your business asset or your rental property, and then you invest that gain in this fund. You can actually hold this for 10 years and then not pay any taxes in the appreciation, which is very powerful. So these are the high level benefits, which is, if you plan it correctly, this can really help investors and individuals manage their capital gain tax. There are few things that we need to know for this program. Okay, what is the deadline? For individuals, if you sell something directly and you realize your capital gain, you have 180 days to invest that in your qualified opportunity fund. Okay, but if you get your gains through pass-through entities like partnerships and S corporations, then you have 180 days from the end of the tax year does not matter when the actual sale happened, end of the tax year or actual tax deadline, April 15th, to start your 180 days. So this actually gives a huge tax planning, or not tax planning, but more time for you to plan your taxes, right? If you're individual, your clock starts right away. But if you invest and if you get your capital gain through partnerships and S corporation, you can extend that 180 window to a longer period. The other thing is, this fund cannot be single member LLC. Okay, you cannot just have $500,000 coming in from your capital gain event and go open up a single member LLC, put the money there and try to invest in qualified opportunity fund or zone. It does not work like that. You have to have a fund. It's a partnership. You can also establish a S corporation if you want, depending on what kind of businesses you're doing, right? But it cannot be a single member LLC. Also, and this is going to get complicated, but if you have a fund and it invests in a qualified opportunity business, that business has 31 or 62 months now because of COVID to invest in any kind of assets we're talking about. But if your fund, the partnership that you just created to defer this, directly invest in the asset, then you don't get that safe harbor. I know it's complicated, but people miss this a lot, so I wanted to bring that up. And I also wanted you guys to realize not all states will conform to this deferral. Okay, the states might tax you right away. So if this was too complicated, I really think you need to talk to your tax advisor and see if you can benefit from this. If you found this video helpful, leave us a comment or ask any questions you have. You can reach to us with all the links in the description below. And we will be adding a lot of other good content in our channel. So I will see you in the next video.